Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Ipg Photonics Corporation Annual Report. Ipg Photonics Corporation offers a wide range of products and services to various industries. The company's product portfolio includes fiber lasers, fiber amplifiers, diode lasers, and laser-based systems used in materials processing, medical, and advanced applications. The company provides a variety of laser products such as hybrid fiber-solid-state lasers, high-energy pulsed lasers, multi-wavelength and tunable lasers, single polarization and single-frequency lasers, and other versions. In addition to these products, Ipg Photonics also offers complementary products like optical fiber delivery cables, fiber couplers, beam switches, optical processing heads, process measuring and monitoring technologies, and inline sensors and chillers. The company's product offerings are not limited to laser systems alone. It also provides various accessories and solutions such as handheld laser welding systems, 2D compact flat sheet cutter systems, high-precision laser systems for medical technology industry, multi-axis Cartesian systems for fine welding, cutting, and drilling applications, and laser and non-laser robotic welding and automation solutions. Ipg Photonics Corporation serves a diverse range of industries including general manufacturing, automotive, consumer goods, medical devices, energy/renewable energy, microelectronics, original equipment manufacturers, instrument manufacturing, scientific, aerospace and defense, rail, and shipbuilding. The company sells its products to original equipment manufacturers, system integrators, and end users through direct sales force, as well as through agreements with independent sales representatives and distributors. The stock price of Ipg Photonics Corp has skyrocketed by 132.02% within the February 2025 to February 2026 timeframe, driven primarily by strong fourth quarter 2025 financial results and an optimistic outlook for 2026. One key factor contributing to this surge was the company's ability to exceed Q4 2025 earnings expectations, with a significant increase in revenue and a substantial beat on earnings per share. This positive performance indicated a shift towards recovery and health for the company. In addition to its strong financial results, Ipg Photonics also announced a new share repurchase program, which underscored management's confidence in the company's long-term prospects. The company provided encouraging guidance for 2026, highlighting growth in high-value applications such as medical, micromachining, and defense sectors. The company's strategic initiatives, including new product launches and market presence expansion, were also seen as drivers of future growth. Analyst upgrades and price target increases further contributed to the surge in stock price, with several Wall Street analysts projecting a significant upside for Ipg Photonics. Overall, the combination of strong financial results, optimistic guidance, and strategic announcements made around the same time led to a significant surge in Ipg Photonics stock price over the past year. The Ipg Photonics Corporation maintains a market capitalization of $6 billion, broadly in line with the industry peer group. Ipg Photonics Corporation trades at a higher price-to-earnings ratio of 193 times and a higher price-to-book ratio of 2.78 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 12% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has aggressively reduced its share count by more than 5%, indicating a strong shareholder-focused capital allocation approach. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. Net income experienced a significant fluctuation between 2023, 2024, and 2025. In 2025, net income decreased compared to 2023 but increased from 2024. The decrease in 2025 was primarily due to a loss on divestiture and sale of assets, as well as impairment charges related to Belarusian operations. Profit margins also underwent changes during this period. While they declined in 2025 compared to 2023, they showed a significant increase from 2024. This change can be attributed to higher tariffs and a decrease in gross margin by 3.4 percentage points. The reasons behind these changes are multifaceted. On one hand, the reduction in restructuring charges and decrease in provision for income taxes due to lower taxable income contributed positively to net income and profit margins. On the other hand, factors such as an increase in foreign exchange loss, a decrease in interest income due to lower cash and investment balances, weighted average interest rates, and geographic mix had a negative impact. Overall, the changes in net income and profit margins can be attributed to a combination of both positive and negative factors that influence the company's financial performance. The company's operating cash flow has been inconsistent over the years. While it generated a significant positive operating cash flow of $247,896,000 in 2024, it experienced a negative operating cash flow of $75,344,000 in 2025. Additionally, for less than 1 year, the company reported an operating cash flow of $69,718,000, which is not as substantial as its positive result in 2024. This variability suggests that the company's ability to generate positive operating cash flow is not consistent and may be subject to fluctuations from year to year. The company's debt level and interest expenses have undergone some changes over the past year. Notably, the unused credit lines and overdraft facilities decreased significantly from $224 million to $78 million between 2024 and 2025. This reduction in available credit suggests that the company has reduced its reliance on external financing. However, the total liabilities of the company increased from $264 million to $296 million over the same period. While this may indicate an increase in debt, it is essential to consider the context of the sale of Russian operations, which resulted in a net loss of $146.6 million. The decrease in net cash used in financing activities from $339.6 million to $54.2 million also suggests that the company has managed its finances more efficiently. Despite these changes, there is no clear indication of a significant change in interest expenses throughout the summaries. Overall, while the company's debt level and interest expenses have undergone some fluctuations, it appears that the company has made efforts to reduce its reliance on external financing and manage its cash flow more effectively. The performance of various regions and segments within the company has been mixed, with some areas experiencing significant growth while others struggled. On a positive note, several segments have shown notable increases in revenue. The materials segment saw a modest 0.3% increase, but more substantial gains were observed in the processing and other applications segments, particularly in other applications, which rose by 19.9%. Within product types, medium-power CW lasers led the way with a 38.5% increase, followed closely by QCW lasers at 7.8%, laser and non-laser systems at 5.8%, and other revenue at 7.2%. Geographically, North America experienced a 3.2% increase in revenue, while Asia saw a significant jump of 14.1%. The rest of world region also reported a small but positive growth of 0.8%. However, not all regions performed well. Russian operations were particularly challenging due to long-lived asset impairments totaling $79 million in 2022. Belarusian operations also struggled, with impairment charges related to long-lived assets amounting to $26.6 million and $27 million in 2023 and 2024, respectively. These poor performances highlight the need for targeted strategies to address these regions' specific challenges. Management is optimistic about the company's outlook, citing several key strategies for continued growth. One major focus area is expanding into new applications where fiber lasers provide benefits compared to other technologies. This includes developing advanced technologies such as Crossbow, a counter-UAS solution for government and authorized parties. The company is also investing heavily in research and development to expand its product line, increase power levels, and improve efficiency. Additionally, management expects continued growth through sales expansion, new product introductions, and manufacturing capacity increases. To support this growth, the company is expanding its manufacturing operations in key locations such as Germany, US, Italy, and Poland. Management is also committed to delivering industry-leading levels of gross margins by growing sales, taking market share, developing new applications and markets, reducing product costs, and optimizing manufacturing operations. While there are risks and challenges facing the company, including intense competition and economic uncertainty, management remains confident in its ability to navigate these issues and drive continued growth. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company has invested heavily in technology to produce volume Bragg gratings and crystals. Additionally, it has purchased a substantial amount of treasury stock, with $53.1 million acquired in 2025 and $343.8 million acquired in 2024. These moves demonstrate the company's commitment to growth and expansion. On the other hand, the company has also engaged in several divestitures. Notably, it sold its Russian subsidiary, Scientific and Technical Association, IRE Polis, for $51.1 million in August 2024. Furthermore, the company recorded a loss of $26.6 million due to the impairment of Belarusian assets in the third quarter of 2024. The sale of property, plant, and equipment has also been significant, with proceeds totaling $0.9 million in 2025, $28.6 million in 2024, and $31.2 million in 2023. The company's financial activities have been documented in the provided summary. One notable aspect is that the company has not paid dividends to its shareholders. However, it has engaged in share buybacks, a common practice among companies to return value to their investors. According to the data, the company has repurchased a total of 6,258,447 shares. This number is significantly higher than the initial 49,432 shares mentioned on page 34. The approximate dollar value of these shares is $3,077, indicating that the company has invested a substantial amount in buying back its own stock. The share buyback program appears to be an ongoing effort by the company to manage its capital and create value for its shareholders. Inventory buildup and supply chain disruption concerns at Ipg Photonics Corporation. Ipg Photonics Corporation is facing significant concerns regarding inventory buildup and supply chain disruption. The company's high fixed cost base and vertically integrated business model may lead to high inventory levels, negatively impacting gross profits and operating results, page 17. Furthermore, excess quantities of certain components and materials are being held in inventory, which could be exacerbated by suppliers' inability to accurately forecast demand. The financial implications of these issues are evident in the company's inventory provisions. In 2025, Ipg Photonics recorded an inventory provision of $30.1 million, page 38, a significant increase from previous years. This is largely due to slow-moving, obsolete, or excess inventory affecting gross margins. The company also experienced a substantial increase in cash used by inventory in 2025 compared to 2024, indicating that manufacturing more products may be contributing to the problem. The excess or obsolete inventory reserve of $30.1 million recorded for the year ended December 31, 2025, page 60, further highlights the severity of these issues. These concerns suggest that Ipg Photonics Corporation is struggling with inventory buildup and supply chain disruption, which could have a detrimental impact on their financial performance and profitability. That concludes the financial summary for Ipg Photonics Corporation. Feel free to comment below, and I will be happy to answer them when possible.